footprint tool, there you have it. Pretty little picture. Now, in a nutshell, every one of these colorful little areas of box, okay, that's what we call a rotation. Now, rotations can be set in a number of ways. We can set them to a point and figure, we can set them to an imbalance, we can set them to be time-based, okay? So there's a lot of options when it comes to setting your rotations. Okay, we're not going to deal with that today. Now, what this effectively is it's one graphic. So it's one picture. Each one of these rotations is one simple graphic that shows us the actual volume traded. Okay, not the bids and offers being spoofed, not what has happened, 5, 10, 15 minutes ago, but what's actually physically being traded between a buyer and a seller. Okay, so it's the actual interaction or the way the buyers and sellers are buying and selling from one another. Now, why this is such a potent tool, an effective tool, is because of the color scheming. Okay, it's the color scheming that gives this tool its real edge. Okay. So yeah, you have it in a nutshell. That is the basic footprint tool. Now, the real edge comes in that when we have got darker shades, so you can see a real darker shade in the middle here and a lot of light shades everywhere else. When we've got these real dark shades, that is showing us a shift in the interaction. Okay, it's showing us a great deal more interaction from buyers and sellers. Now, remember what I said to you right at the beginning. That gentleman said to me he thinks oil's going down. Okay. Now my argument is, what makes oil go down or up for that matter? It's not the charts, it's the physical action of selling the oil market. Okay, and that's where the footprint is stand up, because when we see the physical action of someone selling the market, that is when we can, with a high degree of confidence, say we think a market is going down. Notice the difference. One, we're being subjective, using opinion, drawing upon potentially past experience. The other, we have the past experience, we use that past experience for understanding, but in terms of the execution, we wait for the fact. We don't create the fact, we don't preempt the fact, we wait for the fact, and we act upon that fact. And that's the key to the footprint tool. Now, again, not just with the color scheming on the rotations, but the color scheming on the actual summary box. This is crucial. Now, as you go through, obviously, Axia has launched now its footprint course. As you go through every one of the strategies, I'm going to show you the subtleties, the differences, the interactions that you want to see in order for a trade to become active. So what do I mean by that? Okay. Take, for example, a basic strategy of a breakout. I'm just going to draw this quickly so you can you can see it. Okay, so let's take, for example, a basic strategy of a breakout trade. Okay, so we get the sell-off. Okay, that's a little bit dark. Apologies, guys. Let's get the red one up. Okay, so we get the sell-off, and we approach this area that we call S1. So we're all looking at it, the entire marketplace, you, me, and everyone else. We all want to benefit and take profit and take advantage of this breakout. Now, the problem is most traders can only see this on a candlestick, on a market profile. They cannot see it on a footprint. Okay, now notoriously breakouts tend to fail and have a lot of two-way trade and a lot of in and out and in and out once we've taken out what we all call the support. Okay, now what the footprint allows you to do is it allows you to see the exact interaction point you want to see for that continuation move. Now, I'll give you a clue. A good breakout, okay, a good breakout needs a sustained amount of interaction. In other words, a good breakout, we only want to see sellers keep selling and selling and selling. And yes, there can be buyers, but we need to see that high interaction from the sellers being continuous. And that's where this box comes in, okay, because that allows us to see a continuous amount of interaction, volume, participation, and volatility. That is the footprint tool in a nutshell. Now, why use a footprint tool? It's simple. Okay, the major advantage, what I've got here, some of you will notice this that have started the course. This is from Unit 1. It's free for all of you to take. This is from Unit 1. It's the why do you want ultimately to take, why do you want the footprint tool as a tool? Well, it's simple, okay. On the left here, we've got traditional trading tools. That's your technical analysis, your moving averages, Bollinger Bands, trend lines, all that kind of thing. Okay, we also have the market profile. Now, it gives us a sense of a subjective understanding. Okay, so I'm just going to write the subjective. All right. However, note that subjective understanding is based on intuition, based on pattern recognition, based on observations. Okay, so it's very subjective, because if I see, let's say, a very wide value area, that might mean one thing for me. If you see a very wide value area, it might mean something for you. Okay, so there's a lot of subjectivity within those traditional trading tools as well as the market profile. On the complete flip side, okay, we've got the real leading indicators in terms of information, which are the price ladder and the level 3 data. Now, these would be fantastic tools if it wasn't for the simple fact that there's so much spoofing going on. Okay, you just take a look at any ladder or any price ladder, and you'll see the amount of pulling and pushing of orders. Right? How can you be completely objective if the information you're seeing, you cannot tell what's real, what's not real? Okay, the simple answer is you can't be. And that's the major advantage of the footprint. Okay, what you are seeing is actual, it's physical, it's what has happened. Okay, the 1 lot bought, the 10 lot bought, the 1,000 lot bought, that has just happened. Okay, there's no guesswork, there's no maybe, there's no could be. It's exact, it's fact-based, and it's happening right here, right now. That's the major advantage of the footprint. Now, make no mistake, I use market profiles, I use traditional tools, and I use a price ladder. I also use a footprint. Okay, it's not about one tool being better than the other. Right? It's about adding little edges where you can. Now, the footprint gives me the confidence to execute on the facts. Okay, I learn to understand what are the potential facts that I'm looking for through the traditional tools and the market profile. When I see them on the footprint, I execute. All right, and that's the real key. Like I said to you, that trader said to me this morning, that gentleman said, I think oil's a short. He said it based on what? Traditional tools, market profile. I said, yes, I agree with you. Subjectively, I think oil's a good short. However, I will not short it until the footprint shows me the facts. That's the key. Now, I've gone through this already. What does a footprint show you? Okay, it's very simple. It's a color depiction. It's a summary. It's a summary of exactly what's happened on a rotation. Okay, it gives us all the big shifts. Now, this is really key to the footprint. It shows us relative change. Okay, and this is something that's, again, it's dealt with quite extensively in the course. But ultimately, what it's showing us is what is happening in this interaction set, that interaction set, that interaction set, that interaction set. Okay, now, little example, this was from the DAX this morning. If you were watching the DAX 30, it was a nice little flag. Okay, so the market had sold off and it entered this sideways consolidation. And that's what you're seeing here. Okay, this is the sideways consolidation area. Right, so for almost 30 minutes, we sat going up, down, up, down, up, down. All of a sudden, there was a real shift. Okay, so we could suddenly see an iceberg order being filled out. Now, if you know the basic premise of iceberg orders, once an iceberg order gets taken out, we're looking to use that iceberg order as resistance. So in other words, it was initially support holding the market. Once it then got below it, it turned it into resistance before we saw the continuation to the downside. Okay, so a basic strategy of an iceberg. Now, traditionally, traders would use the price ladder for this. Okay, but what traders don't have the advantage on a price ladder is they cannot get that timing perfect. They were right, but the timing wasn't in the next rotation or the rotation after that. It was in the third rotation. Okay, and that's when we turned that iceberg into resistance and the DAX sold off 25, 30 prices. That's the key to the footprint tool. Now, before we get onto that, let's get into our live analysis. So, what you got in front of you is the oil. Now, how I want to do this is very simple. Okay, I want to show you what a dead market looks like. Because we're talking about oil, because we're talking about, me wanting to take a short. I am wanting to sell this market. Okay, now I posted to the Footprint community group, which is obviously where we're going to share every day the 10 trade strategies that were dealt with in the course, and I've posted this chart. Okay, this is the oil. Now, what we call this is a hiding behind the elephant. In other words, there's a relatively large order being filled out from price 21 to 24.25. Now, how do I know that? Okay, for one, let's look what has happened prior to this order. So let's look at all the volume traded prior. Nothing has gone through the market prior to us trading up to this 21, 22, 23. Suddenly, there's a relative shift. Okay, there's more than 3 times the amount of volume transacted, but price cannot move. That's the key. Okay, there's a high amount of volume, but price cannot keep going up. That's the key. In other words, someone is sitting there absorbing all of the buying potential, and they're doing it over a very, very limited number of prices. Now, a breakout, what you're going to see is a great amount of volume over a large number of prices. Absorption, it's a high amount of volume over a limited number of prices. And that's what you've seen here. Almost over 4 prices, we've seen someone take 3,500 contracts in the oil market. Okay, so we call this hiding behind the elephant. In other words, I want to know what is behind this. Okay, once we take out those 25s, I want to see the market's reaction above 25. Okay, now what in theory how this trade becomes active, we pop above the 25s, and if we see a hard offer, i.e. if we see that seller step in and hit consecutive bids on the way down, bang, we are in on the short, our stop is above the high, and we're looking for a very aggressive move in the opposite direction. Why? Because we've identified the elephant or the seller in the market using the footprint tool. Okay. So that is the footprint. As we can see, one of the key also what you often hear people talking about, the delta on the day. So we can see right now positive 3,400 in the oil. Again, we do have oil inventories later today, but that's very unusual to see the market very close to the high with such a positive delta. So do watch that. That will potentially bring into play another one of the 10 strategies, which is the unwind of the delta. Okay, now the last thing I want to share with you is a trade strategy, again, that was dealt with, it's in the course, but it was also something I tweeted out yesterday, which is the accumulation distribution. Okay, so similar to what you've seen in that oil now, the hiding behind the elephant concept, okay? Large time frame participants, okay, they need to absorb the market, they need to interact in the market at certain points. Now, if you go look at the pound yesterday, just before the cash session opened, okay, we sold off into this area of 140.10s to 140.20. And we saw for a good half an hour someone not just selling, but equally someone absorbing. In other words, there was a great deal of selling going. And we can see that with the relative shift. Look at all the dark blue in terms of the volume versus prior. Okay, so there was a great deal of selling going, but an equal amount of absorption going. Now again, it's absorption. Why? Because we could not continue lower in prices. Eventually, the market started to rotate bid up. But it came back, and this is the real key to an accumulation distribution trade strategy. The real key is when it went offered the second time, it tried to re-enter that zone of accumulation and so quickly got snapped up. And then we saw again a real chunk of buying absorption from 140.22s to 24s before the cable snapped almost 120 ticks higher. Okay. That's why we use it, guys. That's the purpose of the footprint tool. That's the point of the footprint tool. It's to get away from that idea of, okay, I want to buy the cable at 140.04 because there was a support there 16 years ago, and get into the frame of mind, I have an idea that there could be potential support. Why? Maybe it's oversold. Why? Maybe there's a moving average. Why? Maybe there's a good area on the market profile. So that's our subjective approach. All right, we have an idea. We don't blindly buy it. We wait for the market to tell us, actually, someone is buying it, someone with influence, someone that can make price go up. Okay, it's not the chart that makes price go up. It's the buyer. When that buyer comes in, then we can enact our strategies. Why? Because then we have a high degree of confidence that our trade strategy can actually work. That's the footprint tool.